Welcome to my YouTube channel, Legal Information Law Insights. I am Advocate Mukund Mahajan. In today's video, we will understand how the dollar and rupee rate is decided every day. Why does the value of the rupee keep rising or falling against the dollar, and what economic factors work behind it? This video will be very useful for bankers, exporters, importers, NRIs, foreign exchange earners, students, and the general public who wish to understand how the dollar-rupee exchange rate is determined every day. Part 1. The main factor, demand and supply. The daily rate of the dollar and rupee is determined in the foreign exchange market, Forex, where banks, traders, investors, and governments buy and sell foreign currencies. If the demand for dollars increases, meaning more people or companies want to buy dollars, the dollar becomes expensive and the rupee depreciates. On the other hand, if the supply of dollars increases, for example, through exports, foreign investments, or NRI remittances, the dollar becomes cheaper and the rupee appreciates. Part 2. The role of the Reserve Bank of India, RBI. India follows a managed floating exchange rate system, also known as a dirty float. This means that while market forces of demand and supply determine the exchange rate, the RBI intervenes periodically to prevent excessive fluctuations. If the rupee falls sharply, the RBI sells dollars from its foreign exchange reserves to increase supply and stabilize the rupee. If the rupee becomes too strong, the RBI buys dollars to prevent Indian exports from becoming costlier in the global market. Thus, the RBI plays a balancing role in maintaining stability and investor confidence. Part 3. Domestic economic indicators. Several domestic economic factors also affect the dollar-rupee rate. Inflation. When inflation in India is high, the purchasing power of the rupee decreases, leading to a weaker rupee. Interest rates. If interest rates in India rise, foreign investors are attracted to invest here, bringing in more dollars and strengthening the rupee. Trade deficit. If India imports more than it exports, demand for dollars increases, causing the rupee to weaken. Foreign investments. When foreign investors purchase Indian shares or bonds, dollars flow into India, increasing the rupee's value. Part 4. Global factors. The strength of the dollar also depends on global developments and not just India's economy. When the US Federal Reserve increases interest rates, global investors prefer holding dollars as a safe asset, increasing demand for the dollar. When international crude oil prices rise, India needs more dollars for oil imports, which weakens the rupee. Geopolitical tensions, wars, or global instability often make investors move toward the US dollar, causing the rupee to depreciate. Part 5. How the dollar-rupee value changes during the day. Let's understand how the exchange rate moves through a typical day. Morning. Large importing companies, such as oil and machinery firms, buy dollars to make international payments. This raises demand for dollars and weakens the rupee. Afternoon. When NRIs send money to India or when foreign institutional investors, FIIs, invest in Indian markets, the supply of dollars increases, strengthening the rupee. Evening. Banks settle interbank transactions, the rates at which banks buy and sell dollars among themselves. This becomes the base rate for the next day. Money exchange firms and banks then quote rates to the public with a small margin. Thus, the rate you see every morning in newspapers or on websites reflects the previous day's market activities. Part 6. Overall summary. To put it simply, when demand for dollars rises, the dollar strengthens and the rupee weakens. When supply of dollars rises, the dollar weakens and the rupee strengthens. And when the market becomes too volatile, the RBI intervenes to restore balance. Therefore, the daily dollar-rupee rate mainly depends on 3 core factors. 1. Demand and supply. 2. RBI's monetary actions and 3. Global economic events. Part 7. Example, a day's summary. Let's take an example for better clarity. Suppose, in the morning, importers are purchasing dollars, in the afternoon, foreign investors are buying Indian shares, and by evening, international oil prices rise. The dollar rate may increase in the morning, fall slightly in the afternoon, and rise again by evening. This kind of continuous fluctuation reflects how the market dynamically determines the dollar-rupee exchange rate every single day. Conclusion. Thus, the price of the dollar and rupee changes every day, not by the decision of any single authority, but as the combined result of market forces, economic indicators, and RBI policies. Thanks for watching this video. If you found this information useful, please like, share, subscribe, and press the bell icon so you can receive more such important legal videos on time. I assure you that I will continue to provide accurate, lawful, and research-based legal information on various topics through this channel. Your support means a lot to me, so I humbly request you to stay connected with this channel. By joining this channel, you can also receive special legal information and membership benefits. See you soon in the next video. Jai Hind, Jai Bharat.